Hello.
Shall we start, sir?
Yes, sir. Yes, sir. I am ready. We can start.
Hello, everyone. Welcome to today's live webinar. So the topic for today's discussion is holistic way to invest in stock market. We all know how much the topics on stock market and everything else related to finance is debated. So we are lucky to have amongst us the speaker for this topic, that is Mr. Ganesh, sir, who has done masters in business administration and commerce. He has over 15 years of experience in trading in stock markets, and he's been mentoring students. He's also a full-time professor in NITE School of Management, where he teaches finance and accounts to students. So he has seen the journey of investment when it comes to beginners, who has already been doing it for 5 to 10 years, and the experienced ones. So let's welcome sir to our discussion today. Welcome,
Yeah,
sir.
thank you, sir. Thank you. Thank you. Thanks for giving me the opportunity.
No, 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 sir,
Thanks to Bullsmart.
so it's our pleasure actually. So we all know, sir, there is overflow of information when it comes to stocks and everything else in today's world, especially with the technological revolution which we have seen. So we would like to take the discussion ahead. I'll be asking you a few questions. If that's fine related to stock market, we can discuss and you can give your insights and you can, which we can help, in our investment journey. Your journey, sir. I mean, I know if you're trading in stock market, when did you start? And you can tell us a little bit more about your journey.
So I came to the stock market in the year 2008. That is when the big crisis happened.
Yeah.
So I started my career at the time of the crisis. So I have learned a lot at the time of the crisis. So today I'm ready to share all the experiences, which I'm around 15 years of experience in stock market. So it is a privilege for me to share those experiences with you people.
Yes, sir. Yes, sir. So, I mean,
Basically, I'm an investor. Also, I do trading whenever time permits. I do even the trading, but most of the time I spend in doing the investment.
okay. So, can we define the trading and investment, sir? What is the difference? Like you being the expert in the domain, so how would you differentiate between investing and trading in the stock market? Because I know that these are two different things, right?
Yeah. So investment, it is usually done for a longer period of time, whereas trading, it is done for a shorter period of time. Okay, so investors they usually select good stocks and they hold it for a longer period of time. Whereas trade, when it comes to trading, today, for example, if I buy a share at 100 rupees, when it goes to 105, I will be happy with 5 rupees profit and I will exit from my position. Traders, they will be usually looking for a small profit, whereas investors, they will be looking for a greater profit. And the time spent by the investors in the market will be more. It will be more than 1 year usually, whereas traders, his position will be usually lesser than a month. It can be in weeks or it can be in days. Even we have something called as scalpers. Scalpers, morning 9:15 when the market opens, they buy the share at 9:17. Within 2 minutes, they will exit from their position. We call these players as the scalpers. And in trading, usually we use a technical analysis. We usually use technical analysis, that is nothing but study of charts. We study the price and volume relationship, and based on the historical data, we forecast how the market will be. Whereas when it comes to investment, we use the fundamental analysis. It is study of three things. One is economic analysis, second one is industry analysis, and the last one is company analysis. So this we call it as a top to bottom approach. First is economic, second comes the industry, then comes the company. This is called as top to bottom. We have something called as bottom to top. That is other way around. We will first do the company analysis, then we will go to the industry, then last we will go to the economic analysis. So these are the differences between investment and trading. And
Yeah.
also
So,
the investors, they usually invest their own money. They will not borrow and invest their money. Whereas traders, some of the brokering houses, they will be giving leverage. So they will be borrowing money and they will
Market.
be investing. So trader will be ready to take more risk compared to the investor. Investor will not be ready to take more risk. So these are the few differences.
So the investment approach itself will change, right? Whether he wants to invest in the stock market or whether he wants to trade in the stock market.
Yeah.
And the number of trades, I think it's more in trading rather than in investing. Whether they'll choose the right companies, they'll buy the stock that they'll hold for a long time, right? So, and the next question would be, sir, we have seen a lot of changes when it comes to how trading in stock market is being done over the past 15, 20 years. We have seen, so even the account opening, the demat account opening, which was like they used to take 30, 35 signatures in way back in early 2000. Now it has gone to just a click of an app, and it will take a day or two to KYC to be verified. So how do you see? I mean, even the settlement of shares, it has moved from physical formats to e-certificate thing. So what do you have to say regarding this aspect, sir?
See, once this DMAT has come into place, so DMAT stands for Dematerialization of Shares. Before early 2000, we used to have the physical shares. Physical share certificates were being used to give to the investors. But whereas now, all the shares will be in the electronic format. So storage, there is no storage problem. Previously, it was very difficult to store the share certificates, but now everything is in electronic format. And also, as you told, the settlement process is easy now. It is T plus 2 days. That is trading plus 2 days. For example, today if I buy a share, within 2 days, within the next 2 working days, the shares will be allotted into my demat account. Previously, when it was physical format, it was around T plus 30 days. That means if you buy today, you need to wait for 1 month. So that was a big process. But now that process has been simplified. Also, because of this demat, the liquidity is more. If you want to sell your share in case of any emergency, immediately you can find a buyer for that. But whereas in previous scenario, it was very difficult to sell the shares. And also the dividends, it automatically gets credited to
Credited
your
to
bank account. Previously, that was also a difficult task. So
we
all
used to
these are
get in.
the drawbacks which is taken care by the demat account.
And also the brokerage charges also, sir. I feel they have come down significantly with the number of players also being increased in the market. The brokerage charges, how much? I mean, how it was for both for intraday and delivery trading for lot
Yeah,
brokers.
before,
They
yeah,
have
yeah,
come down
we will
significantly. It's not.
So previously the brokerage was great at that greater end, but now many private brokerage houses they have come, and for intraday per day or per trade they are charging only 20 rupees per trade,
Yeah.
and for any delivery of stocks they are not charging any brokerage. For example, if you are investing, then there is no brokerage, but if you are doing trading, then 20 rupees per order. So the
Absolutely.
brokerage cost is also less nowadays compared to the previous one. The important reason being, many companies are coming up, many startups like you people have come up. This is a great advantage to the Indian stock market.
Yes, sir. Thank you. Thank you. We will take it as a compliment, sir. So the next question I would want to ask you is, so for a beginner who is just stepping into the stock market, how does he assess his risk appetite, sir? How will he know in which bracket does he fall under? Whether he should start about investing or he should go about trading? Because each of these takes, I mean, different amount of time when it comes to spending in the market, right? So the trader will be more active in the market. Every day he has to check the markets. When it comes to investing, it's not the same case. So how will he assess his risk so that he builds the portfolio?
Okay, fine. So my advice to the beginners is you start with the investment. Don't go for trading because the risk involved in trading is much higher compared to the risk involved in investment. And also you should start with a minimum capital. The capital which is ready to lose. With that capital, you should enter the market. And also when he is investing, he should invest in the large cap companies. He should invest in the well-established companies like Infosys, Reliance, Wipro. Even when he is investing in these companies, he should do the diversification. He should not put all the money in one stock. For
Absolutely.
example, let me say there is an investor who is trading, who is investing for the first time. His capital is 10 lakh rupees. Assume 1 month back, if he had invested all that 10 lakhs in Adani company shares, his capital would have been reduced to 2 lakhs by now. Because in last 1 month, Adani shares has nearly fell by 60 to 70%.
20%.
So diversification of the investment is very, very important. So as a beginner, never trade. You should be an investor. This is my advice. And also there are few tips. If you permit, I can give those tips to the freshers. Can I go ahead, sir?
Yes, sir. Sure, sure.
So first one is the mistakes. Now I'm going to tell the mistakes which is committed by the freshers. They have unrealistic expectations.
Yeah.
The first and foremost mistake which the people do is they have unrealistic expectation. For example, Rakesh Junjunwala sir, he started his investment career with only a capital of 5,000 rupees. And as of now, his net worth is around 50,000 crores. If I tell this example, next question people ask me is, if I start with 5,000 rupees, can I make 50,000 crore rupees? So Rakesh has spent nearly 18 hours a day. Every day, 18 hours a day, he has spent only for market. Are we ready to spend that? Is the first question. So this is called as unrealistic expectation. See, this is something like you want to beat Sachin Tendulkar's record by playing only 50 matches. He has scored 100 centuries. If you want to score 100 centuries, at least you should play 100 matches. But people want to break his record in 1 year. He has taken 25 years of his
He
time.
did,
So this is
he
unrealistic
did not.
expectation. So don't
He
come
did
into
not
the
become what he
market with
overnight.
unrealistic
Yeah.
expectation. Yes, sir?
That's a good point, sir. Yeah, the investors who are coming, new investors, right? So they want to get rich overnight.
Yeah, yeah. They want to get rich
They get
overnight. That
influenced
is
by
not possible.
whatever content they are consuming, and they wouldn't
That
know
is
the hard
possible
work these
only
people
in
have put in. They
gambling.
would like, if you can take the same example, we don't know how much hard work Sachin has put in to score the centuries. We only want to achieve the result what he has achieved without having to take that extra risk or doing the hard work which they have done
That
throughout
is
their career.
correct. Then, as you told, when Yuvraj Singh hit six sixes, he batted only for 2 minutes. So people talked only for 2 minutes batting, he is getting so much of reward. For that 2 minutes hitting, he has practiced 20 years of in his life. Same with Usain Bolt. 2 minutes he ran,
Again,
but for that he has spent his lifetime.
lifetime.
So first advice is unrealistic expectation. Second is fear and greed. You should not have fear and greed. There is a popular saying in market, you should have fear when others are greedy. And similarly, you should be greedy when others are having fear. So fear and greed, these are the two mistakes which people are having. When another person is greedy, you should be having fear. Now people will ask, sir, how to know whether a person is greedy? When a person is buying a company which is not good, then I will call that person as a greedy person. How to tell whether a person is having fear? When a person
Whether
is selling good stock, then I will call him as a fear person who is having a fear. So always we should keep this in mind. We should have fear when other person is greedy, and we should be greedy when other person is having the fear. So the third
good
point
point, sir.
is not trading with stop loss. There is a concept called as stop loss. For example, I am buying a share at 100 rupees, thinking that the stock price will touch 150 rupees. But as per my expectation, the stock is not going up. Instead, it started falling down. From 100, it came to 90. At least at that time, I should come out of that share. 10 rupees is the loss. But many people, what they will do is they will not keep the stop loss. From 90 it will come to 80. Then also they will not sell. Then from 80 it will come to 30 rupees. Then they will ask me, what should I do? So for that, my question is, what were you doing when stock came to 90? So this is called as risk reward ratio. For 10 rupees risk, you can take 50 rupees profit. But for 50 rupees profit, you are taking 70 rupees risk. So risk reward ratio should be good. Always keep a good risk reward ratio. Another question people ask, should an investor should also keep the stop loss? Stop loss usually traders will keep. Next, people ask me whether investors should they keep the stop loss. The answer is yes. The traders they will keep a stop loss near to their entry price, whereas investors can keep a stop loss which is deeper. Instead of keeping 90, they can keep 70 rupees as stop loss, so that their loss will be minimum. People should be ready to accept the small losses. If they are not ready to accept the small losses, then at the end they'll be accepting the bigger losses. So this is the third advice. Next, fourth one is changing the position from investor to trader, and vice versa, from trader to investor. This they should not do. You should not change your position. For example, I am a trader. I bought a share. My target was 110. I bought at 100. My target was 110. Once the target is reached, I should come out of that stock. So here the greed will come. Stock has gone to 110. They will hold this stock hoping that it will go to 130. It will go to 130. Again, they will hold the stock thinking that it will go to 200. But it will not go to 200. Again, it will come to 50 rupees. So never change the position from trader to investor. This is the next mistake. Next one is giving preference to price than the value. Many a times freshers, what they do is they will buy the shares which is having less price, 10 rupees, 5 rupees, 2 rupees. First they will look at the price, they will not look at the value. Assume an investor is having 10,000 rupees with him and he wants to buy. He will not go for Infosys, because if he buys Infosys, he can buy only 8 shares of Infosys. But if he buys a stock which is 1 rupee, he can buy 10,000 rupees, 10,000 shares. So they look at the quantity, but they never look at the value. So people should look at the value rather than looking at the price. This is the next advice. Next one is people should have patience. Patience is very, very important. Today we talk about Warren Buffett. He is the richest investor. He started at the age of 10, and now his age is nearly 90. He has nearly spent 80 years in the market. Because of his patience, he has become the richest investor. So patience you should have as an investor. Buy good stocks and then you should wait. Don't buy bad stocks and then you should not wait. Buy good stocks and be with patience. So these are the few tips for the freshers. Yes, sir.
Yeah, good sir. So that's what basically they should not book profits based on the greed, and they should not have fear and fear in booking losses. If they feel it's going down, they should put stop losses. So stop loss is one important thing which they have to consider, both investors and traders, while taking any position, so that they don't maximize on the losses. At least they should not have the fear and book the losses right away.
Yes, sir. Sir, in
Sir,
market,
thank you.
whatever, the important thing is whether you make profit or not. Safety of capital is very, very important. Capital safety is very, very important. If you want to win the game, first you should be in the game. If you lose the capital, then you will be out of the game. So preserving the capital is very important. This is what I'm trying to tell.
Yes, sir. Thank you. So we have covered the mistakes. So you told diversification is important, right, for the portfolio. Sir, I have the understanding that diversification is also type of hedging. When you will give away the risk which you are exposed, the exposed risk, you will give that some coverage, so that if in case of some uncertainty, you will not end up making huge losses. So what's the other way to hedge? Suppose I have a portfolio. So how do I go about hedging if it is already diversified? So at the same time, what will be the optimum level of diversification? So I should not over diversify also, right, my portfolio, so that my returns will get. They will take a hit if I'm over diversifying the portfolio also. So would you like to put some light on that, sir? Hedging other than diversification, and how not to over diversify the portfolio?
A very good question you asked. Many mistake people do is, one is over diversification, or second one is under diversification. Under diversification, they will put all the money in one stock. That is called as under diversification. Whereas when it comes to over diversification, they will put, if they are having 1 lakh rupees, they will buy 100, they'll invest in 100 companies. One share of all the 100 companies. So in this scenario, tracking your portfolio will be very difficult. So my advice is you should not have more than 20 stocks in your portfolio. Not more than 20 stocks in your portfolio. So this is the right diversification. If you put like one share in each company, then it becomes over diversification. For example, I have 1 lakh rupees with me and I want to lend that money. First option is I can give that 1 lakh to one person. To Mr. A, I can give the full 1 lakh. Second option is I can give 25,000 rupees for 4 people. Between these two, I will say second option is good. 25,000 rupees you give to 4 people. So that even if one person runs away with money, still I can recover the money from the remaining 3 people. Now one person will ask, why can't I give one rupee to 1 lakh people? This is called as over diversification. Is it possible to identify 1 lakh people? No. Even if you give, can you get back that money? The answer is no. So don't have more than 20 stocks in the portfolio. Then another question which you asked was hedging. Correct, sir. Another question was regarding the
hedging. How can I hedge my portfolio? I mean, other than using the diversification. So how else can I hedge it? So if I'm buying any derivatives, I can also hedge the portfolio, right? If I'm also investor and a trader both, so I'll be going about opting that hedging.
Very simple, sir. So first of all, let me tell to my viewers, hedging means it is nothing but mitigating the risk. A very simple example I will take. Let me say today there is a match between India and Australia. And I am a supporter of India because I feel Virat Kohli is the best batsman in the world and he will play good against any team. So since I am having hope in Virat Kohli, I am betting 1,000 rupees with Mr. Subra for 1,000 rupees. And you are playing for Australia because you think Australian team is very strong. Whereas I am betting for India because of Virat Kohli. So today, before the start of the match, the betting has been fixed between me and you. Now, after the toss, I came to know that Virat Kohli is injured and he is not playing this match. So now, for me, without Virat Kohli, I think Indian team will not win the match. So what I will do is, I will go to the another person. I will search for another person. There I will take the opposite position. With you, I was playing for India. There I will go. There I will tell I will play for Australia. Same betting amount is same 1,000 rupees. At the end of the day, whether India wins or Australia wins, I will not lose money. Because if India wins, you will pay me the money. Whereas if Australia wins, whatever money he pays to me, Mr. X, that money I will give to you. So this is called as hedging in simple terms. When it comes to stock market, now when you are expecting the markets to come down, what you can do is you can go to the derivatives market. There we have a position called as short position. If you take the short position, you will be making money in the derivatives market, whereas you will be losing the money in equity market. Similarly, if the market is going up, you will be making money in the equity market, whereas you will be losing money in the derivatives market. So net to net, if you see, you will not be having any loss. But whatever money you invested in equity market, for the same amount, you should take the short position in the derivatives market. In my first example, the amount was 1,000 rupees. In the same manner, assume your portfolio is 10 lakhs. Then you should take 10 lakhs worth of short position in the derivatives market. So that net to net, your losses can be mitigated.
Okay. So earlier you mentioned about the fundamental and technical analysis, sir, and and you also said there will be 3 levels for fundamental analysis, 3 different levels. So when we are doing technical analysis, so we use charts, indicators, and all. So would be the main indicators to, I mean, go-to indicators for any trader. So how will be able to uh, identify the trend in the market? How
Okay.
can you put some light on that, sir?
See, first of all, sir, the main indicator is price and volume. I will tell price and volume is the main indicator. We have four different scenarios here. Increase in price with increase in volume, we call that as bullish. Prices going up, also volume going up. By saying volume, I refer to the total shares bought and sold. Volume is nothing but the total shares bought and sold. If prices going up, volume also going up, that gives me a bullish signal. Similarly, if the prices falling down, volume also falling down, again that is a bullish. Again, that is a bullish. Between these two, between first and second one, I will call the first one to be more bullish. Prices going up, volume going up. That is more bullish compared to the second one. Now I'm coming to the third scenario. Prices increasing, whereas volume decreasing. That is bearish. That is bearish signal. And fourth one is prices decreasing, volume increasing. Again, that is bearish. So these are the four scenarios. Prices going up, volume going up, bullish. Prices coming down, volume coming down, again bullish. Prices going up, volume coming down, bearish. Prices coming down, volume going up, that is bearish. And if you want, few more indicators are there like moving averages, stochastics. Then we have something called as support, resistance. So all these things you can add. But main thing is price and volume. And second one is the support and resistance. Support is an area where the buyer should buy the stock, whereas resistance is the area where the buyer should sell the stock. The investor should sell the stock or the trader should sell the stock when the prices reaches the resistance. So resistance is the selling area. We call it as selling zone, whereas support is the buying zone. So these two are the main important things.
So okay. So that is what technical analysis. Thank you, sir. So the next question will be again regarding the fundamental analysis. If I'm an investor who just begin my journey, so how will I choose the companies or sectors? So I'll have to do some research before investing in these companies, right? Basically, fundamental analysis. I have to read. I have to dig into the company. How good the company is. How will the company fare well in the coming years? That's what I'll have to bet upon basically when I'm investing in any company. So how will I choose the sectors? So will it be something, say in India, whatever the time is going on, I think it's good for metals and auto sectors. Do we have to identify that as the right opportunity to invest, or so do I mean also look upon my expertise? If I come from an IT background, I have better understanding of how IT companies are working. So if I go about investing in that sector, how will I finalize the sector or choose sectors before investing?
Okay, sir. Now I will help you. See, during the COVID period, all the sectors were affected except the IT sector because they were having the provision of work from home. IT sector was least affected during the COVID times. Now, your question is how to choose the sector. Simple answer, I will give it in a simple way. See, the India population is 130 crores. The population of India is around 130 crores. Out of 130 crores, maximum I would tell, only 10 crore population would be having the own house. Remaining 120 or 100 crores, they will be living in rent house, rented property. So what I expect is in future, the demand for the housing projects will be more. Because 100 crore population is, they don't own a house. So if the demand for housing is increasing, automatically all the sectors will be affected. Cement sector, to build a house, cement is required. So cement sector will do good. Then steel, as you told, steel metal, to construct the house that is required. Paint, that is required. This is called a sectoral analysis or industry analysis. Now, in paint sector, which company is good? If I ask anyone, they will tell Asian Paints. That is the brand. So this is called as company analysis. So in paint sector, I will take 10 companies, 10 top companies. Then I will go through their balance sheet. I will see their profit and loss account. I will see their ratios, cash flow statement. All these things I will go through. Based on that, I will do the judgment. Also, you can look at the market capitalization. Market capitalization is nothing but share price multiplied with number of shares. Invest in the company which is having greater market capitalization. That is called as large cap. As a fresher, we should avoid the small cap and mid cap. We should invest in the large cap companies because the risk involved in small cap is big compared to the risk involved in the large cap.
Large cap.
So similarly in IT sector, top performing companies, Infosys, it can be Wipro, it can be TCS. So technology sector. Similarly, I see pharma sector to do good. Till human beings are alive, pharma sector will be there. There is no closure of pharma sector in the near future. Till we are alive, pharma sector will do good. In pharma sector, which are the top companies we need to search? It can be Sun Pharma, it can be Dr. Reddy's. All these are the top companies in those sectors. And also we should go through their balance sheet. Balance sheet analysis we need to do. And also we should see the dividend payout ratio. Many people will be looking for the dividends. So what is the dividend payout ratio given by these companies? All this comes under the company analysis.
Okay. So next question would be, sir, we'll move on to the economic concepts now that we have covered few of the stock market concepts. So we been hearing from past 3-4 months that recession is around the corner. U.S. market was at its bare bottom. Now it's been it's all some recovery in the last couple of months. Again, the last week there was some bank, which was SVB bank, which crashed, which again led to market plunge. The Nasdaq and Dow Jones plunged in US. So for a person who is not so expert, who is just begin his journey, how should he go about in such recession times, or what he should expect, or he should go? He should try to approach the market in a conservative way. How we should go? How can
A
he be
very good
cautious?
question you are asking. Now your question is whether the investor should avoid the investment right now.
Yes,
Is
sir.
this the question?
To put it in simple way, that's what I would say.
Okay, so the answer is very simple from my end. Many people have not lost money in recession, whereas many people have lost money expecting the recession to come. They are not investing the money expecting the recession to come. This is what happened. The history says this. The sentence which I told, it has been said in the history. People have not lost money in recession, but people have lost money expecting the recession to happen. So my advice is, if you are having a bulk amount, don't put all the money now. You can go for SIP, systematic investment plan. Every month, you can buy the quality shares. Even if the recession happens, that is the time where the quality stocks will be available at a cheaper price. So at that time, you can take the advantage. All the quality stocks will be available at a cheaper price during the recession period. And also, if the recession happens, it will not last. It will not last long. See,
That's
first
to
of all,
bounce
whether
back again.
recession happens, that only I don't think so, because 3 months back or at the beginning of the last year, the inflation in US was around 9.1%, if I'm right. But as of today, the inflation has come to 6%. So there is a decrease in the inflation. Also, the Fed, they are taking care of the inflation by increasing the interest rates.
That's right.
So even if the recession happens, it will not last long. Even if it happens, Indian economy, it will not have a major what you say. It will not
Impact
be
on.
affected majorly. Indian economy especially, majorly it won't be affected. And also, if you see the prices, the stock price, one thing was overvaluation. That was the first concern, overvaluation. Second one was recession fear. Some portion of that has been discounted in the price. Some portion of that has been discounted in the price. If you see in last week, the markets is falling because of the overvaluation. So now it's the right time to buy the stocks through the SIP, systematic investment plan. But don't invest all the money now. You should invest slowly and steadily, because slow and steady will win the race. And also, in case if it happens in the future, you can do averaging. Averaging means 100 rupees you bought now. After 1 year, price is 75. 100 plus 75 divided by 2. Your price is 80 rupees. Average price becomes 80. Like that, you can start doing the averaging concept. But do averaging only for the good shares. Don't do averaging for bad shares. You can do averaging for Reliance. You can do averaging for Infosys, Wipro. But don't do it for scrap companies. This is me.
So, I mean, my next question would be: so, is there any correlation between the Indian indices and the global indices, SGX or Dow Jones? Because SGX is something. I mean, the market is it's open it opens at 6 o'clock in the morning. It's open till 11:30 in the night. And US market it opens after the Indian markets close down. And Australian and European markets will be opening parallelly along with Indian market. So what would be the correlations when it comes to see? Does it have anything to do with the volumes of FIIs and AIs are inflow? I mean, which are flowing in and flowing out of any particular market. Like, so how do we, if we have to draw a correlation? So what would be the better way to approach this?
See, the straightforward answer is there is a positive correlation between Indian market and other market. If you see, if all the Asian markets are in green, then even Indian market will be in green. If all the Asian markets are in red, most of the times even Indian market will be in red. So there is a positive correlation, and also there is a correlation between share market and gold market. That is opposite correlation. If the share market goes up, gold prices comes down. Similarly, if the gold prices goes up, then the share market comes down. Because people love to invest in gold because people consider that as a edge against the inflation. Gold investment in gold is considered to be the edge against inflation. And also from last 2 days, if you see, the Nasdaq market, Dow Jones is not doing good because of that one bank which you told, SPC. That fear now people are having in Indian market. See, always we consider US as the king. If the king is sick, we all are like kingdom. Kingdom will also be sick. If the US is not doing good, kingdom will also be sick. Once the king becomes sick, kingdom also becomes the sick. So there is a positive correlation.
So I also feel market tends to overreact sometimes just to the emotions or the news which are floating in the market, sir. Sometimes if there is some rumor also which has come out, we have seen stock which has crashed. I think it's yesterday only in Maharashtra. There's another bank called SVB Bank, and people misunderstood it for the US bank which crashed, and they stood. I mean, I think they ambushed the bank and they wanted the deposits back. So
That's what I told, sir. When others are having fear, we
yeah,
should
we
be
should not.
greedy.
Yes, sir. That
That
was a
is the
nice
right
point.
time to buy the good stocks. So when fear is happening, people will sell the shares madly. Left, right, center, they will sell. When people are selling, the price it decreases. That is the time to buy.
So basically, we should look at the larger picture rather
Yeah,
than
larger picture. You should look at the larger picture.
following the herd. We can, I mean, try to become the leader or the bellwether of
Yeah,
it.
definitely, sir, definitely. Always you should look at the larger picture.
Yes, sir.
As an investor, you should think what will happen after 5 years, what will happen after 10 years.
Okay. So, nice, sir. Thank you. I think we have covered all the questions. I would like to say it was wonderful talking to you and getting to know more about the stock market. And I think all our viewers, I mean, I think they would have learned something new from this video, and they'll not do the common mistakes which everybody is doing in the market. So, like,
Thank you, sir.
thank
Thank
you,
you.
thank you for giving us your time, sir. Which would
Yeah,
really,
thank you for giving me the opportunity, sir. So, from Nitte School of Management, on behalf of Nitte School of Management, I thank the, I thank
thank you,
your
sir.
team. Yeah,
Thank
yeah.
you, sir. Thank you.